think so. And obviously, we'll see how different regulators push back against that, right? Because you're gonna have people trying to save the system from the new entrants. But overall, I'm all in favor of basically private money, basically innovations being able to do what they're going to do. And if other people accept it as money, then it becomes money. And so that's kind of been the history of money throughout the ages. And so I'm certainly in favor of that. And any sort of kind of like contracts that people want to make between themselves, I think I support that in almost any context. And so hoping that we're going to see basically a large and larger, digital asset space over the coming decade, and that more of this will be transferred. Because a lot of our conversation is going back to what are policymakers going to do? Is money supply going to go up? Is fiscal spending going to happen? We don't know. Whereas if you have more algorithmic monetary policy, then that at least gives people, even if they're still using a currency, a fiat currency for other purposes, at least they have a digital asset that they can store value in, or that they can transact with anyone they want, without having to get permission, right? So I think that basically scarcity and permissionless payments, and all sorts of permissionless, say, lending environments or trading environments, those are obviously, I think, really good things for people to have access to. And in many cases, I find that the most pushback against that is in developed markets, where they're saying, well, why do you care about permissionless payments, or why do you care about store of value? Isn't the dollar a good enough store of value? And it's like, well, sure, in developed countries, we've had less extreme tastes of this. Whereas if you're living in Argentina or Lebanon, you have to sell the idea less there, because it's like, well, they're not going to say, well, what do you mean store of value? Why would we need a store of value? Well, they obviously need a store of value, and so you have that argument. And then even in developed countries, because we're getting this more inflationary outcome, especially not just inflation, but also like negative real yields. So inflation that's happening while bank accounts are still yielding roughly 0%. It's easier to make the case to say hold Bitcoin, and you say, okay, it might be volatile, but with fiat currency, it might be less volatile, but you're guaranteed to lose money. And so, say Bitcoin is volatile, but at least it's volatile in the up direction just as often or more than it is in the down direction. And so I think over time, there's more global adoption of these types of assets, rather than relying strictly on their fiat currency. And especially in emerging markets where they just have fewer options, they have less access to equities, and it's really about, they have the fiat currency, they have their home, and besides that, they haven't had a lot of other ways to try to store value and offset those inflationary risks. Partially. So I think the other factor, probably the bigger factor, is the fact that the bond market doesn't fully believe the inflation narrative yet. And so they're still kind of banking on it being transitory. And of course, that the bond market is partially influenced by the Fed buying bonds, right? So that's kind of a complicating factor. But so if you look at gold, for example, gold historically follows, real yields, which is basically the 10-year treasury minus the break-even rate. And the break-even rate is basically the treasury market's forward inflation expectations over a 10-year period, right? And so that's measured by the difference in yields between, say, the 10-year yield and the TIPS yield, the Treasury Inflation Protected Security yield. And so the bond market is basically saying, okay, inflation's 5% now, but we think it's going to be more like 2.5% averaging over the next 10 years. And so by that metric, it's less worried about inflation than the near-term indicators are signaling. And so gold is kind of, because it's a rather financialized asset, it's kind of following those break-evens more closely than it's following the real-time inflation numbers. And so I would say that's the biggest factor for if you just look at gold compared to those, it's actually doing almost exactly what you'd expect it to, where those break-evens kind of peaked and gold peaked, and then ever since you've kind of had the real yields kind of come off of their bottom, you've had gold kind of also come off of its top. And so that's kind of one story. But then I do think in terms of magnitude, I think that gold could have had a bigger spike. It might have corrected less if there weren't these cryptos competing with it, right? So obviously, among younger investors in particular, when they say I want to protect my money against fiat debasement, they go out and buy Bitcoin, and then they might buy Ethereum, and then unfortunately they might buy Doge, and you kind of go down the rabbit hole of things they might buy, but a lot of them are not gold. And so silver is still somewhat popular among younger investors, but a lot of that interest has translated into the digital asset space more than just gold and silver. Pretty much the same as I described it in January. And for people that follow my work closely, I have a research service where I update on, say, Bitcoin more regularly, and I also include some Ethereum updates in that service. And so, for example, even though I have, concerns about Ethereum in the long run, I say, okay, for example, in January, I'm like, if this breaks over 1400, that's a really bullish sign. And then I kind of watch that Ethereum to Bitcoin ratio, and I kind of monitor that over time. So my overall viewpoint for this run has been that I'm somewhat tactically bullish on Ethereum, while still having kind of questions and concerns about the longer term technical details and implementations there. And so even in my January Ethereum piece that was otherwise pretty critical, one of the things that I was pretty favorable on was EIP 1559. That was kind of the one thing I singled out, as saying I actually think that's pretty elegant for Ethereum to do. And so I do think that staking and EIP 1559 have been pretty good for the Ethereum protocol, over this past year. And I actually had a conversation with Raoul Powell I think it was probably a month ago now. And basically my view was that when you have ETH2 on the horizon and you're locking up, ETH into that staking, and then you get EIP 1559, I think that, that can be pretty bullish for the price in a similar way that a Bitcoin halving, can be pretty bullish for the price. And so we've seen Bitcoin come off of exchanges until this recent correction. You had a brief period of Bitcoin going to exchanges. Now they're kind of back to coming back off exchanges. You've seen similar dynamics with Ethereum leaving exchanges and going into these more illiquid formats. And so overall, that is pretty good for the price action while it happens. And so whereas, my concerns with Ethereum are more longer term rather than say 6 to 12 month price action. So I kind of separate how I analyze price action of Bitcoin and Ethereum versus how I analyze, the fundamentals. And it's, even going back to Bitcoin, for example, when Bitcoin broke below, like, say, 46,000 back in May, I kind of issued an update to my subscribers saying, okay, I'm still long-term bullish on Bitcoin, but we're clearly seeing a risk-off environment in terms of price. And so just like when I analyze an equity, there's one story about what the fundamentals are doing, good or bad, and then there's another story about what the price is doing, good or bad. And so I kind of monitor that kind of relationship over time. And sometimes my opinion on the fundamentals and price are roughly in line, whereas other times I might have a difference of opinion between price and fundamentals. And so I think one way I'm looking at Ethereum and some of the altcoins is that I'm kind of treating them in a similar way that I would treat an equity, and it's somewhat different than how I treat Bitcoin, which is as a money. So I think that's probably if a mental model has clarified it all over the past 6 months, it's really about treating a lot of those platforms as equities in a similar way that I would treat, say, equities in the stock market. I don't know. And so I've been in my research service pretty much ever since it broke down. I've been kind of unclear about the near-term price action while still favorable long-term about the fundamentals. And so, with Bitcoin, for example, I was like, until this breaks over like 41, 42,000, there's not a lot of, bullish tactical indicators to kind of go by. And Ethereum, I forget exactly what price target I gave, but it was like until it breaks over this price target, I'm also just not super favorable on it. Whereas, I wouldn't, that's different than, say, selling my cold storage stuff, right? I'm not selling my cold storage stuff, but I'm also saying, like, from a 3 to 6 month perspective, until I see kind of price confirmation, I can't really be bullish. And so that is kind of separating those different time horizons. Whereas long term is really going to be about what's happening with the fundamentals, what's happening with regulatory clarity to allow pools of capital to go into those assets at a bigger way. And so I do think that, especially in 2021, we've had an inverse relationship between quality and price among tokens, right? So you've had things like Doge skyrocket, whereas, say Bitcoin and Ethereum have actually gone up less than, say, Dogecoin or Ethereum Classic and things like that. And so basically, I think you still have to have some of that froth kind of taken out from some of those periphery projects before you can see kind of sustained rises. And another thing to keep in mind is that now that Bitcoin and Ethereum and some of these other protocols, the whole space is like, big enough to be a macro asset. It's more influenced by these macro headwinds. And so, over 2020, people were getting stimulus checks that they could pile into stocks or cryptos. Whereas if those stimulus checks dry up, that's less retail money that can pour into the space. And so I think, you have the kind of this period of consolidation where you separate the good projects from the bad projects until you can build a base and have the next bull run.